If you're like me, then the chances are you want to make more money with less properties. Now, I'm not talking about all the usual ideas to increase your cash flow that you've probably heard of, such as serviced accommodation, HMOs, or hybrid buy-to-lets, and all the other fun strategies that people love to make up. No, in fact, I focus on vanilla buy-to-lets, and I plan to keep buying them as I want a hands-off property portfolio that can see me into a really nice retirement further down the line. And whilst I may well venture into some other strategies in the near future, in this video, I'm talking about making more money from the same vanilla buy-to-let property portfolio. And I believe this can be done in three main ways. Number one is buying valuable stock. Number two, reducing debt over time. And number three, creating a plan. And in this video, I'm going to cover those 3 points. So let's start with number one. Number one is going to be, we need to look at buying more valuable property. And before some smart ass says it in the comments, I'm not dressed for the London Stock Exchange. 1, 2. I am here as a property investor. I've come straight from a meeting, which is why I'm dressed so lovely today. And I'm here to tell you how we can make more money from property. And number one is we need to buy more valuable property. And let me explain. Here is a very quick recap for you. When I started out in property investing, I had two main thoughts. Number one is I don't have very much money. I had approximately £16,000. And number two, I'm not willing to wait 3 years to slowly save up more money from my job and then buy a property closer to home. My home is on the south coast, whereas I'm investing in Liverpool. So I took the little capital that I had and I found what I believed was the best possible investment area at the time. Obviously this is back in 2019, and I purchased my first buy-to-let property in Liverpool for £58,000. And that purchase worked out really, really well. I had a low capital down, I found a tenant relatively easily, and I'm making monthly profit of around £265, which since then has actually increased up to about £385 per month in profit due to rental increases over the years. But seeing as that purchase worked out so well for me, I went on to purchase multiple other properties that kind of fit that similar spec. In fact, the next one was £50,000. The one after was a £71,000 purchase. Then it was a £54,000 purchase. Then it was a £65,000 purchase, all by kind of the end of 2022. So all low purchase prices, all relatively decent sized refurbs, and then end values ranging between £80,000 and £125,000. But it was some time after I had started buying these properties that I had a conversation with an investor, and I had this kind of realization, change of mindset, that smaller, cheaper properties are great to have in the foundation of any portfolio. But at some point in an investor's journey, it's a good idea to start purchasing higher value stock, higher value property, so more valuable property. And here is why. Number one, we need to think about capital growth. Generally speaking, across the UK, areas with higher priced properties have increased more in value. I think that's a fair assumption given the prices are now higher, so they must have increased more. And whilst this balance of growth has been changing over recent years, it is safe to say that these higher value areas such as London, Brighton, parts of Surrey, parts of Kent, Manchester, Bristol and many, many other places are likely to continue going up in value due to their popularity. Therefore, if they do continue to increase in value, and even at a smaller rate of growth percentage than other parts of the UK, well, the equity gain is likely to be high due to the overall property value. Remember that wealth is most commonly built through property by holding it long term, and through the capital gain that comes with paying down the debt and the property going up in value. The aim of the game should always to be buy a property for say 150,000 and then it be worth 300,000 in 20 years time, with as little changes or money spent on it as possible, rather than maybe buying a smaller property of £50,000 and then that being now worth £100,000 20 years later. It ultimately would still be a success to buy the smaller property, but the larger gain comes from buying more valuable properties. And this might mean tying up more money in each property, and it might actually mean a lower yield per property as well. This is the smart long-term move for any investor that is wanting to build a more profitable portfolio in the long run. So this is largely tied to kind of what your end goal looks like. And for me, it's to have less rooftops more profit per property. Some people will take this approach and know it as the monopoly strategy, which is something I'll cover in a future video. So that was capital growth. The other side of this, and the other reason we should buy more valuable properties, is rental prices. And this one was the real mindset shift for me. And I've been trying my best to try and think about how I can explain this to you. And what I've come up with is this. What does a business do when they are trying to grow? Typically, they do one of three things. The first thing is LTV. They'll focus on the lifetime value of a customer. So if a customer on average spends £200 with a company, they like to think about, right, what can we do to get that customer up to £300, not £200? If we can increase their average order to £300, we've increased the lifetime value of the customer. Number two is to increase the revenue. Okay, if you want to grow a business, you put more time into marketing and sales, reinvest as much as you can, increase that revenue if you want to grow. So you're pushing the revenue top line up. And then number three is you try to make it more profitable. Okay, inevitably, when you're pushing up the revenue, you then start to slack on your profits a bit. They start to suffer because you're putting so much money into trying to grow the overall beast that when you actually then do grow the beast, the next aim of the game is to try and allow profits to catch up a bit. Try and minimize your expenses or learn how to save on cost and bring down the cost, increase the profit. So lifetime value, revenue, profit. And that is exactly what I think we should be doing with the second phase of our property portfolios. So once we've purchased the first few cheaper properties and built that small foundation of our portfolio, now we're thinking about how we can get to higher revenues and how we can in the future increase the profit margins. So my answer to this is to target properties with higher rents. Now this might mean buying in better areas, or it might mean buying larger properties. But overall, I want to move away from buying the smaller properties where the rents are say £600 a month, and I want to move to the type of property that has a minimum of £1,000 a month in rent. And in the short term, there really isn't going to be that much benefit. The property rents for more, but the debt is higher due to the higher purchase price or the higher refinance price. So at the beginning, the likelihood is that both the cheaper and the more expensive property are going to earn about the same amount of money, which is about £250 to £300 profit per month as a vanilla buy to let. But in the future, like when a business dries up revenue first and then adjusts to make more of a profit margin, well, in the future of property, if we have now paid down some of that debt, we now have a far larger rental income because we've gone for the larger rental property, and then compare that to the lower debt amount. Well, now we've got a bigger profit margin to choose from. And we've got a bigger margin with the £1,000 property to the £600 property with our debt. So the next topic that I want to talk to you about is reducing debt, which of course is another way that we're going to make more money from property. You see, I think debt in the property investing world is the topic where I find people are most ignorant. Yep, I said it, sounds harsh, but there are some really smart and driven property entrepreneurs out there, but ask them this one question and watch their face go blank, okay? And that is, what will you do with the debt in your portfolio when you retire? And it usually prompts either a blank face or one of the following few silly responses. Number one, I'm going to die with all my debt. Number two, oh, I'll just figure it out when I'm older. Or number three, I haven't thought about it yet. But the reality is, the best deals that I have ever bought have been from tired, struggling landlords. And they are fed up with the game, they are nearing to retirement, and they haven't given a second thought about reducing their debts. And because of this, they now have run-down properties. They have rented them under market value, and they are over-leveraged in debt. But that's not going to be us. We are smarter investors. We think into the future. In fact, I think a lot about my portfolio in 10 or 20 years' time. And these are the questions that I tend to ask myself. First of all, would I rather 20 properties or 10 properties that produce a similar profit margin? So obviously the first answer there is probably going to be less properties producing the same rent. Less roofs, less boilers, less tenants, and less potential maintenance. I love having lots of properties, but I want less of them making the same amount of money. Obviously, I don't want to just have one property earning me all the income, because I do want to spread my risk between a few, but I don't want loads either. Second question is, how hands-off or hands-on do I want to be? And the answer is, I want to be hands-off. Hence why I'm making sure I have a good foundation of vanilla buy-to-lets, because I want good assets that I feel proud to own and that make me good money. And the last one is, will I repay my debt? And the answer is, of course, yes. And I will do that through strategically growing my portfolio and then switching over to repayment mortgages, managing my equity to debt ratio, and I will also repay my debts over the next 30 years. And this nicely brings me to the third part of this video, and that is to create a plan. Most people are very good at doing the goal setting in the beginning, but not everyone is as good at the exit planning. Now, just as I know how many properties I want to get to overall and how much profit I wish to make from property overall, I need to know exactly how I intend to pay down that debt and plan for the future. So for me, this looks like the following. Years 0 to 5, I'll be purchasing lower priced property on interest only mortgages. Years 5 to 10, I will purchase slightly higher priced properties on interest only mortgages. Years 10 to 15, I will switch 25% of my portfolio over to repayment mortgages or make overpayments. And years 15 to 20, well, I will slow down or stop buying altogether. I will switch 50% of my portfolio over to repayment, and year 20 onwards, I will sell off bad stock, keep the best ones, and pay off the debt from the sale proceeds of the ones I do sell. Overall, I should be left with an unencumbered portfolio, meaning no mortgages, or at least that is my goal. So my question to you is, what does your exit plan look like? Something to think about following watching this video. But before I go, please let me caveat this video by saying I love low value properties. It's what got me started, and I will still continue to buy them. I'm just more focused around properties that achieve more rent and maybe have a higher value now. Ultimately, getting started is more important than waiting for the right moment or the right type of property to come along. I like to live by the mantra of movement, not perfection. Otherwise, you'll never get started. So if you're just getting started, get involved with those lower value properties if that's the barrier to entry, and then slowly increase as the years go on. I'm not making big jumps up. I'm going from the 50, 60, 70,000 pound house to now the 150, 160, 180,000 pound house. Maybe in the future I'll change that again. But I hope you've enjoyed this video. I hope you've learned something from it. Thank you for watching, and I'll see you next time.